Well, my guest on the show is someone who I have always admired for his ability to understand valuations and predict and indicate market cycles to our viewers and to their unit holders. Prashant Jain of HDFC Mutual Fund, rarely seen on TV, but he joins us at the outset of this Morningstar conference. Prashant, first allow me to wish you, your family and your team a very happy Diwali.
Thank you, Nikunj, and I wish you and your family and your viewers a very happy and prosperous new year ahead too.
Prashant, 2017 was supposed to be a dull year. Demonetization impact, Trump economics was at play, GST rollout, big question mark, but it has turned out to be a dream year for the broader market and also for Nifty 50. So what really has done the trick for us this year?
See, one, I think we cannot forget the basics of equities, that 1 year returns in equities are extremely hard to forecast. So having said that, I think if you look at the last 10 years, not 3-5 years, but last 10 years, you will be surprised, but the Nifty CAGR is only 6%. The nominal GDP CAGR is 12 to 16%. Year on year it is slightly moving up or down. This means that our market cap to GDP has fallen to quite low levels. So I think there is a lot of value in this market, especially in the large caps. If index in a growing economy like India trails by 8% per year, the economy, you can appreciate what kind of value is there. So I think that is what is playing out. This value is not very visible to a casual observer, because the profitability in quite a few sectors is passing through a very challenging phase. But I think that phase is coming to an end, and I think over next 2 years we should see this concern getting addressed that earnings are not growing. I think we are now likely to enter a phase of very healthy earnings growth going forward.
Prashant, a year ago or a year and a half ago, if I would have given anyone a combination of low interest rates, a declining or big drop in commodity prices, and government's initiative which were targeted towards stroking the economy higher, anybody would have bargained for a stronger earnings regime. But the grain of the truth is that earning has not kicked in. Why are you confident that this time around earnings will pick up? Whether it happens in 2 quarters or 4 quarters, that's debatable. But the fact that you're confident that earnings will come back, I just want to understand that.
So I think it is quite simple. See, what has happened is, I mean, all of that you said is true, but you miss one important factor. In 2015, steel prices globally fell to 15 or 20-year lows, and steel is extremely important for India, both the economy and for the banking segment. And that sharp downturn in steel prices, and till the time the government could impose anti-dumping duties or MIP, a lot of damage had been done. And it is the sectors which get impacted. See, when steel gets impacted, it is not just steel. Banks are getting impacted. Capital spending is a serious casualty. If 8 out of 10 steel companies are on the verge of bankruptcy, then who is going to invest in a sector? And metals is one of the key drivers of private sector capital expenditure. So this sharp downturn, unexpected massive downturn in steel prices in 2015 took a toll on not just metals, but on corporate banks and also on the capex. Now if you see where are we, and this is what gives me confidence. I mean, one is NCLT, which is, I think, over next 2 quarters we should see resolutions, progress there. But apart from that, steel prices, metal prices have gone up quite substantially. So the profitability of steel companies is very healthy now. Under this NCLT, there are several media reports which are suggesting a high level of interest in buying out these assets. So I think this is what gives me confidence that the sectors which dragged down the EPS growth, they are coming back to normalcy. The other sectors have been doing well, but if 3 sectors out of 10 don't do well, or they report losses, or a 80% degrowth in profits, it will impact the aggregate. I think that is now all set to change to my mind.
Now, you've argued in the past that the cycle which has played out in the past 3 years is unlikely to play out in next 3 years, which is a combination of IT, pharma and consumer, and so far you're getting it right. So I first want to compliment you on your call on pharma. It may be a pain point when you went underweight on pharma, but now I see that there's a pricing pressure and FDA problem. Are you buying the fear, or are you still sticking to your thesis?
No, I think both IT and pharma are great businesses. They are very sustainable businesses. It is just that if you look at pharma, what has happened, the prices have come down, but the multiples have not corrected. If price has become half, the earnings have also become half. So the multiples are still rich. So therefore, I feel that I personally feel that the value in IT is probably better than in pharma, though both are good, great, globally competitive businesses.
Now, pharma has two problems. One, FDA inspection. That's like a manufacturing problem. That's a process which I'm sure Indian pharma companies will sort out. But they're losing pricing power in global markets because of competition and variety of factors. Do you think the price erosion, which has started a couple of quarters ago, that's here to stay?
See, I think there are some structural changes that have taken place in the US pharma market. One, the market has consolidated very sharply. So just 2 or 3 buyers account for a bulk of the US market. So the distributors in US have come together. They have consolidated. So that is one significant headwind that this industry has, and it will remain because the bargaining power is very strong with your customers. The second thing, I think what has happened in the past due to some supply disruptions in some companies, either in India or outside India, companies were able to take significant price hikes in few molecules, and that is what supported extremely very high levels of profitability in that industry. That part is going away. So I read an interview by the new FDA commissioner.
Yes.
So he has said that FDA will give approvals on a priority basis to molecules which have less competition. So they are very focused on bringing down very high levels of prices. So I think if in this kind of an environment, wherever there is excess profits, that will go away over time.
So to go underweight on pharma was a great call, but to go overweight on metals couple of years ago, and especially Tata Steel or steel stocks, was also a brave call because you went against the crowd. You went against the crowd and you got it right. What is the way forward for metals? Because ultimately metal is a global play, and at least my understanding of China is very, very difficult. So how do you judge a commodity which is global in nature? Because you've not bought too many metal stocks in the past, and this time you bought Tata Steel very aggressively.
See, we have bought metal stocks very selectively. If you look at last, 2 decades, there have been few occasions when we have bought metals, and we have bought when the cycle was extremely weak. See, steel, Indian companies are very competitive in steel because we have iron ore, we have coal, we have the technology, we have the markets. So it's a good sector to be investing in, and market always gives more importance to recent profits than to long-term value. So when do you get great long-term value? When a sector is passing through pain. So metals, when it passes through extreme levels of pain, it will throw up opportunities, but you have to wait for pricing to improve. If steel prices fell to 15 or 20-year lows, the pain is not just to Indian companies, it is also to every single global company. So supply will get cut, many companies will go out of business, and the prices were at a level where most companies were losing money. And if you buy a business which is sustainable, which will sustain the challenging period, when things improve you will make a lot of money, and I think that is what happened. In few cases, this change from very difficult situation to a good environment happens fast, like it happened in steel in 2 to 3 years. But it took 4 or 5 years in oil companies. If you go back and see around 7, 8, 9, 10, 11, oil companies, for some reason or the other, the subsidies were not going away, either due to government policy or due to oil prices or due to currency. So that is what is uncertain in investing, that I know this is not sustainable, this situation, but how long it takes to resolve, at times that is not in our control, and environment can change. Look at corporate banks. Why has it taken longer than what was anticipated for the problem to solve? Because the downturn in steel prices in 2015 created additional stress. But the thesis is intact, that there is value, but you had one more problem to deal with. And once you create a problem for a large country, for an industry, it takes 2-3 years to sort itself. But now I think we have come to the stage where even that is getting sorted out.
So you think the thesis with which you bought corporate banks, that thesis of economic recovery is still intact?
Very much. I don't think it will not, because India is a growing economy. Bank deposits, I mean, they continue to grow. India credit will grow fast. What is the pain point in the corporate banks? It is just one. It is the high provisioning cost, high level of NPS. Fortunately, in India, by these banks, bulk of the non-performing loans are against secured assets, assets which still have value. And rupee was 45 rupees to a dollar 5 years back. Today it is 65 rupees, which means the replacement cost of these assets has gone up. So I think the haircuts in many industries, in many cases, large cases, will be small and relative to what was the markets was pricing in. So I think, as if I look at next 1 to 2 years, I think corporate banks in India should revert to normalized levels of profitability.
But the regime, Prashant, couple of years ago for banking in general was very different. Now you've got competition coming from NBFCs and fintech firms. If interest rates they move higher, the treasury benefits which corporate banks have enjoyed, that also could be the missing link. So for corporate banks to do a mean reversion, the environment has to be very, very benign, which may not be true.
See, higher interest rates will actually be great for banks.
Okay.
Because banks have CASA.
Yeah.
So, but the other segments what you mentioned, they have no CASA. So actually high interest rates will be the best thing. I don't wish for high interest rates because economy is still not doing well, we need capex to recover. But should it happen, I don't think it will be negative for banks. Maybe you could have a situation where treasury gains are not there, but the core profitability of banking, the pricing power of banks will come back, and interest rates will move up on lending only if there is demand for credit, which will actually be a great sign.
Another good call, or another very brave call when you took the call, was to go underweight on consumers, especially staples.
So that has not worked for us. Actually, it has hurt us. If you look at last 1 year, lever we thought was expensive at 40p, now it's at 60p. It is one of the best performing stocks.
Despite the Patanjali competition.
So it has not worked for us. So this call has clearly, the underweight on consumer staples has hurt us, and I think we have been in a similar situation even earlier, and if this logic is right, if rationale is right, if these high multiples will, if the growth will not be commensurate with these high multiples, despite it not having worked for 1 year, I think over the next 2, 3, 5 years it should work out. Unless of course the numbers turn out to be much better than what our understanding suggests.
So what is the best way to bet on consumer? Because the India romance is consumption. If interest rates come out, discretionary spending and non-discretionary spend, they both are likely to go higher.
So I think it is quite simple. As a country progresses, as a society progresses, certain categories become affordable by the masses and they become highly penetrated, and they will become mature categories and the growth rates will slow down. If you look at bicycles, for example, I think they have been degrowing for 3 decades.
Yes.
Motorcycles were growing much faster, and now cars are beginning to grow faster than motorcycles. Airline traffic, why should it grow faster than passenger rail? Because people are moving from rail to air. So I think you can play the Indian consumer, and which is what we have done, by buying consumer discretionary products, which as you go up the income levels, as society, country progresses, what you could not afford to buy earlier, what you can afford to buy, the less penetrated categories, I think that is what will exhibit faster growth.
Of late, there has been a lot of macro suspicion. I won't use the scare. Scare is a bad word, but suspicion is that oil has stopped falling, it has started rising. Interest rates, looking at RBI commentary, may have hit a bottom, so to speak, and government may go easy on fiscal deficit. Now, the India story for last 2 or 3 years, Prashant, has been that we've got great macros and poor macros. If the macro changes slightly, is that a risk?
I don't think so. See, oil prices have stopped falling, but I mean, oil up to 60, 65, even $70 is okay. I don't think if India could survive $100 of oil 10 years back, we can certainly handle $70 of oil. So yes, lower oil prices are good, but I don't think there is anything to worry about oil at these prices. The second point you mentioned is on interest rates. So as we have also said in the past, I think the room for a further fall in interest rates is clearly limited. But if interest rates remain around these levels, plus minus 25 basis points bond yields, I don't think it changes anything. The GDP growth which everyone is so focused on, if you plot the quarterly GDP growth, if you look at the quarterly sales numbers of cars, if you look at the quarterly sales numbers of truck freight or passenger, you will see that in the demonetization quarter and in the quarter before GST, most indicators have experienced a slowdown. And I think it is, to my mind, it is reasonably simple. It is because of GST, it is because of demonetization, because everyone would agree that these were significant disruptions to the way business was being done. But I don't think the impact of this would last beyond a quarter. In fact, if you look at the numbers of last 2 months for car sales, for airline traffic, for power demand, you see very encouraging signs. I don't know if you have noticed, but power prices are up by 30-40%. The merchant power
traffic is growing at 20% every
power
year.
demand in the month of August grew at close to 8%, which is I think one of the highest readings that we have got in many years. So I firmly believe that India's macroeconomic fundamentals are very good, and we should not get distracted by the weak GDP growth, which was directly because of this two very structural, very difficult reforms that we have carried out. And I think over the next 2 quarters, things should revert back to normalcy. The RBI governor has said 2 days back,
Capacity
second
utilization
half,
has to go
no,
higher.
he has said second half growth he expects it to be around 7%.
I'll change the scope of the discussion to the current environment, and the question which I guess everybody wants to understand is asking, and the answer what we are looking forward to is that what should be the asset allocation. You've always insisted on various forums that before you make a market view, first check on your asset allocation. 80% of the wealth is made when you have the right asset allocation. So given that we are at an all-time high, small cap stocks have run ahead of themselves, what should be the asset allocation for next 3 to 5 years in this market?
See, in a growing economy like India, over time the index will keep on hitting all-time highs. This was 100 one day, it became 200, 500, 1000, 2000, 5000, 10,000, 20,000, 30,000. But if you look at the index, it is doing something really simple. Over long periods, it is compounding at around 14-15% a year, which is in line with the nominal GDP growth rates. Isn't our economy hitting a new high every year? Yes. So over time the Sensex should also hit new highs. So I don't think we should get confused by that. As I said, for last 10 years, the index has trailed the nominal GDP growth by 7-8% per year, which is a very substantial underperformance. So I think this index, to my mind, is not excessively valued. And what we have said time and again in the past, I will say again the same thing. All that each one of us needs to do is to divide our wealth in 2 parts. One part of our wealth is the safe capital, which we don't want to take risk on. So that should be committed to fixed income products, irrespective of what interest rates are. The other part of your wealth, which you can call the risk capital or the growth capital, which you are prepared to keep it aside for 5 years. I don't need this for 5 years. And on this I can emotionally and financially handle volatility. That is the right pool of money, portion of money to be invested in equities. And I think the best way to go about it is to pick out 2, 3, 4 good diversified equity funds and invest over 6 months to 2 years through a SIP or STP. In that will further reduce your volatility. And I think in today's environment, the preference should be for either multi-cap or large cap funds. So I think the risk reward is slightly more favorable for that category.
So I won't get into a debate whether small cap versus large cap, but you generally feel risk reward ratio is higher in large cap. So my next follow-up question would be that what determines your return is also entry price. At the current juncture, 10,000 on the Nifty, 30,000 plus on the Sensex with a P multiple of 20 plus on the index, should return expectations be diluted now?
This 20p is based on what? Everyone is saying this 24p, 20p. What p are we talking about?
Historical comparison.
So why?
Okay.
In 3 months from today, we are in October.
Yes.
In 2 months,
next year,
in
yes.
2 months,
Yes.
right? You go to March 19.
Fair point.
So should you look at March 19 or March 18 or March 17? 1 year from today, what will we be focused on? March 20.
Yes.
What is the P of the index based on consensus earnings of March 20? It is 14 times.
15 times.
So
Yes.
where is it expensive? See, the index has trailed nominal GDP for 10 long years. In fact, if you do a simple exercise, and I can also give you the data, whenever in the history of in India, whenever the Sensex has delivered below 6-7% returns in the past 10 years, the next 10 years it has delivered very good return.
That's a great insight. So
Very simple.
That's a great insight. So focus on large cap because that's where when the economy turns around.
Multi-cap, see, in small mid caps, even though as a group they may be expensive, but the number of companies is so large that a talented person is able to pick 20-30 companies which offer good value.
So why the consensus or the chorus at the Morningstar conference is that we market upar ja raha hai because there is a lot of liquidity. There's so much of money coming, we've been forced to invest. You don't buy that argument.
Not at all. So I always say that we should never talk of the numerator ignoring the denominator.
Which is?
So what is a lot of money? 20,000 crores. But what is the denominator? It is the household pool of savings. What is this? This is 3 billion a month, 36 billion a year. Household pool of savings is $500 billion. So what does this translate to? 6%, 7%. So is it excessive? If Indians as a group invest 6-7% of their savings in equities, I don't think it is reckless at all. Globally, people invest 20, 30, 40%. So I think what is happening is I think the understanding amongst by far most of the people, I would say, there could be exceptions, but most people who are investing in equities understand that it's a long-term investment, equities are volatile near term. So I think the understanding about mutual funds, equities, SIPs is at a fairly good level, and thanks to people like you, media has played a very important role in that as well.
I'm asking you slightly broad questions because people really look up to you for advice in terms of asset allocation. In the past, when you've seen market imbalances, you've been the first one to call it out also. But as of now, for a 3 to 5 year horizon, you think that one should still invest in equities, and if you've not started your SIP, start. If you've not increased your commitment, please go out and increase that commitment.
Whatever is your risk capital, I think it is not late to start investing in equities because the prospects of this economy are very promising. Valuations, to my mind, are very reasonable. But you should never assume that this every month what you are getting returns, this will continue. Equities are a volatile asset class. They can catch you by surprise at any point of time. And they are not going to tell you in advance, okay, look, 2 months from today I will catch you by surprise.
You don't know when the monkey is going to ring the bell, of course.
So as long as we stay committed, we have a reasonable asset allocation in line with our risk profile. We have a 3-5 year view. I don't see any reason for concern to commit more money in equities.
So really, closing comments, and I want to summarize our today's interaction. I may sound slightly repetitive with this one, but this is important for our viewers to get a comforting sense from you. You think that the economy is on a mend and valuations are not stretched, and all this bear talk about valuation stroke excess liquidity, you think for those who are making these opinions, they are taking a very myopic view.
See, let me not say whether they are see, it is their view. So, but I would say I am not concerned. Index has trailed nominal GDP for 10 years. That is the fundamental. Many businesses have weak profitability. I think that will fix itself. Look at the steel companies. Aren't their shares up 4 times?
Yes.
So what is it telling you? That companies are doing well. If these companies are doing well, what does it mean? That the NPAs in that sector should get resolved. So if that gets resolved, if you read Mr. Chandrasekharan's interview, of Tata Sons 2 days back. What has he said there? Tata Steel looks to double its steel capacity in India by 2022. Now, isn't that the beginning of a private capex cycle?
And he also said that I'm looking at buying growth inorganically.
Both organic and organic. But isn't that the beginning of a capex cycle, private capex cycle?
Great point.
So I feel that within the next 1 year, we will also see early signs of a revival in private capex cycle. I think this economy will go from strength to strength over next few years. Markets will always have their highs and lows, volatility, but if you have a 3-5 year view, if you can tolerate volatility, I think equities hold reasonable promise.
It's a great way to summarize today's interaction, that economy will go from strength to strength. And thank you very much, and thank you for your lovely insights. Always enjoy interacting with you, and perhaps learn a bit about market understanding.
Sure. Thank you, Nikunj.
Thank you very much.
Thank you.
Thank you very much.